Hello, once again here at Stuart Heath, founder and CEO of Harvard Grace Capital, with another edition, part 4 actually, in our key investment terms that everyone should know when thinking about investing. This week we're going to cover time value of money, hold period, commodity, and equity. What is time value of money? It sounds kind of scientific. I guess it is a little bit. But the time value of money is a concept that essentially says a dollar that you have today is worth more than a dollar that you have a year from now. Because you have it now, you can spend it, you can use that dollar, you can use it to make more dollars and you can't do anything with the dollar that you don't get for a year. Well, this is a very basic concept. It gets involved with compounding. Most of you did compound calculations when you were in high school math and things like that. So the compounding has to do with time. So the time value of money, money today is worth more than the same amount of money a year from now. For instance, when after the pandemic and interest rates shot up and everybody was running to the bank and picking up their CDs at 4.5% and 5% and just thinking, thank God. We're doing this. How many of y'all realized that you were still losing money because real inflation was still 9 and 11%? I had many of these type conversations with investors because we were paying a current cash on cash at 5.5, or 6%, and that was just part of the return. They said, "Well, I can do better than that putting the money in the bank." Well, no, you can't, because you didn't take into account the tax benefits and the capital gain that'll come on later on. Time value of money includes this sort of concept that you must make sure that you're beating all of your other costs, or else your money is actually going to decline in value, and that's what inflation does to all of us. Hold period, similar. It's you really can't calculate a rate of return either for the future or in hindsight without knowing the hold period. How long did you have the asset? Completely tied in with the time value of money concept. If I'm going to put a $100,000 investment and I'm going to not expect a return on that for 5 years, then we're going to calculate what's our annualized rate of return for that, and it needs to be well on up into the teens and 20% to make that worthwhile and make that beating many other investments such as a dividend-paying stock or something like that. A commodity. Commodity is an asset class that refers to owning of goods that are essentially identical to everything else in that class. You can call it pork bellies, wheat, gas, fuel, barrels of oil. So they're not specifically identified, but they are commodities. If I own 100,000 barrels of oil and I go to sell it, do I really care which 100,000 barrels of oil are mine? No, just that we got the economic value on it. So commodities, a lot of money to be made in commodities. They tend to be very volatile. And you can think of almost anything as a commodity, especially raw material related. It's a very lucrative and volatile asset class that you really need to know a lot about that class before you try investing in that. But its unique characteristic to be a commodity is that all of the goods inside that commodity are fungible. They're not identifiable from the other goods in that commodity. Equity. Equity means a lot of different things. Equity can be an asset class. It generally means an ownership position, such as stocks. It can also include preferred stocks. Equity can also refer to the unlevered portion of an asset. If you own your house is worth $100,000 and you owe $50,000 to the bank, your equity in that property is $50,000. Your unlevered piece of that, and that's the piece that you own and that you can actually utilize to reinvest in other assets. So those are our terms for today. We got many more in the weeks to come. So tune back in and watch us next time. Would love to hear your thoughts. Thanks. Bye.